Who should pay the sales tax on the service fee revenue from cash discounting or surcharging? Today, I want to talk to you about a concept that really should be pretty simple, but like most things in the financial services industry, it's become very complicated. My name is James Shepard. Thanks for taking time to listen or watch this episode. And I got a call, actually got an email the other day from a sales representative in the New York area. And New York, of course, has some very specific surcharge laws, which we'll talk about in a minute. And he told me that he had a client that was currently on cash discounting. It was, I believe it was a retail client. And this retail client on cash discounting, it had a competing company that came in and said, oh, you're already doing cash discounting. They said, okay, is your processing company, are they paying the sales tax on the extra revenue you're collecting from the service fee? And the retailer's like, no, I'm paying that. And they said, oh, that's terrible. You should switch to us because we would pay the sales tax on the service fee revenue that you're collecting. So I want to break this down and I want to talk about it because it is kind of an interesting concept, but I want to talk about a few things here that are very, very important. So first of all, for those of you watching this video that aren't very familiar, what is cash discounting? What is surcharging? So surcharging is one thing. Surcharging is I'm going to add a fee whenever somebody uses their credit card. Okay, so I have a business, I have a retail business. Let's say I sell bicycles for $100 each. And I say, well, if you buy that bicycle with cash or with a signature debit or PIN debit card, any kind of a debit card or cash, it's going to be $100. But if you buy that bike with your credit card, we're going to add maybe a 3.5% service fee on top. So you're going to pay $103.50. That's a surcharge. It's one thing. It's just adding something on. Okay. Now, what is a cash discount? Well, a cash discount is two things. The first thing is it's a price increase. So you're increasing the price of everything in your store. You're just doing a price increase. Now, depending on which state you're in and the different rules that apply and things like that, you might be raising your price by informing at the door and at the counter, informing the consumer that your regular price is increased. Or you might actually be changing the prices on the shelf or on your website or whatever, right? So any way you slice it, you're raising the price, right? Then you're offering a discount when people pay with cash, okay? Now, why would somebody do cash discount versus surcharge? Well, the real reason behind this is because with surcharging, there are Visa rules, compliance rules, where Visa says if you're going to do a surcharge, you cannot add that service fee to debit transactions, only to credit transactions. And so the cash discount is a way where, protected by the Durbin Amendment, if it's done in a compliant way, it's a way to basically get around that restriction and say, what we're going to do is we're going to raise the price on everything, and we're only going to give the discount when somebody pays with cash. So the net effect is that in that bike store that sells bikes for $100, people are paying that higher $103.50 on credit and debit transactions. They're just not paying the higher price when a consumer uses cash, okay? So we're talking about a cash discount program here. So the question is, we have a merchant, and let's say that they were getting $20,000 a month in revenue, $10,000 from cash, $10,000 from credit debit cards, and so they're making $20,000. Well, now they implement a 3.5% service fee, and that's how they're notifying their customers with a sign at the door and the counter. They're saying all the listed prices would be the cash price. We have implemented a price increase of 3.5% on everything in the store, right? So now if they do the same $20,000 in revenue, $10,000 in cash, $10,000 credit and debit, that $10,000 is going to be $10,350. So their total revenue is now going to be $20,350. So the question is, who pays the sales tax on that extra $350 in revenue? Well, it's actually pretty simple if we're talking about cash discounting. Remember I said cash discounting is two things, not one thing? It's a price increase and then a cash discount. So if we are doing a price increase, whose revenue is it? Is it the business's revenue or is it the processor's revenue, right? Well, it's obviously the business owner's revenue. You can't say that that doesn't apply to the business owner. Obviously, it's processor's revenue as well, but that is still revenue for the business owner because they're doing a price increase. When you do a price increase, you raise your regular price on everything in the store, and that means obviously you've got to pay sales tax on that additional revenue. So the first thing to understand is that if somebody is claiming that they're going to pay the sales tax on the extra revenue from the service fee, it is impossible to claim that that is a compliant cash discount program because that would indicate that there wasn't a price increase. What that indicates is actually that there is another service provider, in this case, the processing company. They are providing a service directly to the consumer of allowing the consumer to use their card, and then they're collecting the revenue, and so then they would be responsible for any, tax implications, right? Not the business owner. But here's the really interesting question. So number one, that's not a compliant cash discount program. End of story. There's absolutely no way you could make sense of that. It's impossible. The really interesting question is that then a surcharge? No, it's actually not a surcharge either, because a surcharge means that the merchant is adding something onto it. So it's still the merchant with the surcharge. It's still the merchant that is choosing to add on this surcharge. And so that becomes revenue collected by the merchant. It's going to get reported on their profit and loss, and they're going to have to pay sales tax on that revenue. The only situation where you could say that the processor would be doing the sales tax, in my opinion, would be something like a convenience fee. Now, the convenience fee model really hasn't made it into the retail restaurant space, and for good reason. There are very specific rules about convenience fees. Maybe I'll shoot another video on that one next week about convenience fees and how they work. But if you look that up, that is a totally different concept, the convenience fee. It's the kind of thing that a lot of utility companies use, phone service providers use. And so the idea there is that it's actually the processor is providing a service directly to the consumer. The consumer is paying them 3.5% of the transaction or $5. Usually convenience fees have a set dollar amount. It's $3, it's $5. They're providing a service where they can then collect that revenue, and the service they're providing is the merchant doesn't allow you to use credit and debit cards, but we, XYZ Processing, we allow the consumer to use this if they pay us a convenience fee, and then we're paying the business owner their portion of the money. So you could technically run it that way, and then the processor would, potentially would take some of that tax liability away from the business owner, but now you have a convenience fee with a whole different set of rules and regulations. So again, future episode, we'll talk about convenience fees, but I just wanted to make it really clear that in my opinion, I'm not an attorney, I'm not an accountant, but in my opinion, and I think most of you would agree with me, there's really no way to have a compliant cash discount program where the business owner is not paying the sales tax on the extra revenue collected, because a cash discount is two things. It's a price increase and it's a cash discount. The extra revenue is coming from the price increase, and by definition, a price increase means that the extra revenue is a revenue for the business, which means they have to report it and they have to pay sales tax on it. My name is James Shepard. Have a great day.